Welcome back to the Raw Selection Private Equity Podcast. Joining us today is Paul Isaac, Managing Partner of Isaac Management LLC, a private equity firm investing in the lower middle market. Let's dive in. Paul, if you can share with us a brief insight into you, please.
Yeah, sure. So, currently living in Detroit, which is kind of the core of, like the Midwest industrial manufacturing kind of space. But I actually grew up in Missouri, St. Louis, spent my entire life there, and then moved overseas. I come from an Arabic background. So my mom and dad are both from Iraq. And after high school, we moved there for a couple of years, went to college overseas, started working overseas. I was doing private placement deals for the U.S.-led mission in Iraq. So this is 2014. So you're old enough to remember the war with ISIS. No offense. Yeah, and so I was doing some consulting work and private placement work out there. While I was in college, and then I studied economics, came back home, started off in banking, capital markets, and then transitioned really over into the deal side of things, structured products, private credit. Landed in Detroit after coming back from overseas, spent some time in Chicago, and then came back to Detroit about 2 or so years ago and launched Isaac Management. There's like a lot of like fluff words out there, but I think really at the core, Isaac it's really a holding company of sorts. So we operate in the lower middle market private equity space, but we don't have a fund. We don't have fund investors. We're not structured like a typical private equity firm. There's no fee structure. There's no fund life cycle, predetermined exit dates. And the thesis was really straightforward. It was buy and hold these companies forever, like just as long as we want to hold them, cash flow assumption to complete perpetuity, and then really kind of build platforms. So we have 4 separate segments that we focus on: the industrial industry, manufacturing, financial services, and business services. And that's kind of what we're working on today.
Very good. What's one mistake that you see private equity firms or portfolio companies making, and what would you suggest to correct them?
One really big mistake, or you want like a few minor ones?
Yeah, let's go big.
I think probably the biggest mistake is overleveraging and not really knowing the target market of the company that you're buying. And you can say that all that stuff comes out in due diligence, but that's really where all the bodies are buried. Like, at the end of the day, everything looks good on a spreadsheet, and you can make just about everything work one way or another. But what you have to really integrate into is the actual culture of the firm and then the market that it serves. And that's especially important for lower middle market companies, because this is not multinationals. This is not, some huge national grocery chain doing $1 billion or $2 billion top line. Like, these are effectively small businesses. Some are doing $1 million in revenue. Some are doing 5, 10, 20. And these companies are really ingrained in their communities. And so if you come in with the traditional, buy and flip mindset, which, through no fault of their own, like these private equity executives, like they have a structure, like they have mandates that they have to adhere to, and they have a fund cycle. And so if your fund is set to exit in 5 years, well, you have to exit in 5 years. And what you're going to do is you're going to do the best that you can for your investors. And so that's where you see a lot of juicing, a lot of financial engineering and that sort of thing. And you don't see the same connectivity to the actual community, where these businesses are really the core lifeline of, So call it a cultural disconnect, call it whatever you want, but I think really, really understanding like the company itself, the employees, and then the customers that it serves in that either local community, regional community, whatever the case may be. I think that's a gap, because people want you to be successful, and people don't like change. So if you buy a grocery chain that has, 3 or 4 supermarkets, and, grandma has been shopping there for 50 years. She doesn't want anything to change. She wants to go to the same place. She wants the same people to say hi. She wants the same service, et cetera, et cetera. And so knowing that becomes extremely important when you're dealing with kind of this market segment, in my opinion.
What's a bit of a broad question, but what's your take on what you're seeing, obviously, with your focus, financial services, manufacturing, etc.? with the kind of deal trends and what's happening in the lower middle market at the moment?
I think the lower middle market is really in a kind of a flux period right now. And what's interesting is deal volume slowed down a lot during the Biden administration. Obviously, we saw an uptick in interest rates, which priced a lot of investors out of deals or just made it not make any sense at all anymore. Which, I mean, that's going to happen. You're going to have cycles. That's fine. But the lower middle market, again, because it's so concentrated and these companies don't have the same access as like a larger private equity firm coming in to buy out a company, or even just a large like a commercial banking level client, somebody doing 50 million plus. They don't have access to the same resources. They don't have access to the same tools. So what a lot of private equity buyers, the larger companies, is they can actually go in and they can hedge interest rate exposure. And so they can make money on whatever they lose over here. They'll make it up somehow, some way. But in the lower middle market, you really don't have access to that. I mean, your options are like ABL lending, traditional commercial loan. There's SBA financing, which has been, I want to say, pretty reasonable, but it's the government. They extract their pound of flesh. I'm sure you're familiar with that in the UK. And so it's in a bit of flux. Interest rates have pretty much doubled, almost even more, since 2021. And so when a company is going to market and they're talking to a banker or a broker, that banker's job is to sell the company at the best price that they can get for their customer. Okay. But what ended up happening, and I wrote an article about this, what ended up happening is you have bankers and companies stuck at one price in a period of time. The cycle changed, but the pricing and the structure didn't change. And so you have a bunch of buyers on this side who are ready to transact. I mean, there's something like $2.25 trillion right now in private markets that's ready to be deployed. That's a huge number, but it can't be deployed if it doesn't make sense. And so these deals stopped making sense financially. It became too expensive. The DSCR was too low. Banks wouldn't finance it. Nobody would back it. And neither side would back down. And so we got caught in a quagmire over the last couple of years. And so deal volume it's definitely slowed down. I think interest rates are a big contributing factor. I mean, when you had, prime was plus spread, something like 6%. And today prime and spread is 13%. All of a sudden that deal makes absolutely no more sense. And that's kind of where we found ourselves. And, I know it changes every week pretty much now with this administration, but now they're estimating 3 interest rate hikes between now and 2027. So does it get better? I think so, but it's just going to take people who are actually transacting to really understand what's underneath everything. And I think people are slowly starting to wake up to it, but I think it's going to take some time.
In reference to your portfolio, talk about kind of deals and the consideration and flow and everything else that comes from that, and whether the lower middle market's in for those or not. How's all of that with the rates and the ambiguity and uncertainty? How's that affected your current portfolio and how they're navigating things?
I mean, the effect on anybody's portfolio is you're going to take a hit on the bottom line. And when you talk about something like tariffs, which is it's effectively a second tax on what you're already paying. And when you're in the manufacturing business or the industrial business, you're extremely exposed to changes in commodity prices. And so when those commodities go from $1 to $5, well, now all of a sudden, things don't add up just as much anymore. So I think industry-wide, and I'm talking from a PE perspective, maybe not the companies themselves necessarily, but industry-wide, you're seeing haircuts across the board. And folks are taking losses, folks are repositioning, folks are trying to refinance where they can. But you're seeing a lot of pressure on these companies, especially companies that have kind of a debt-heavy leaning balance sheet. I don't want to say anybody is like in trouble per se, and it's not something that anyone can come out of. But what I am saying is that it takes a little bit of patience and a little bit more thought than before, where you could just refinance out of a situation, pretty much anybody would pick it up. Money was basically free. Terms were, really loose, and everything was fine. Everybody wanted to do a deal. And now you're seeing folks that are a lot more conservative. Underwriting standards have really tightened quite a bit. Debt has become more expensive. And, the same company that had a DSCR of 2 last year is now teetering, at 1 and 1.25. And so those deals can become extremely hard to finance at reasonable terms. You're going to have those, merchants are going to try to sell you on like a payday loan or something, but I don't think that that's the right thing to do. So overall, there's definitely compression, but the way that I look at it is right now we're in, I wouldn't call it like a bear market completely, but I would say this is a real kind of a correction and readjustment type of phase. And it's just like the comment I made before. I think we come out of it. I mean, it's really only a matter of time.
Absolutely. A quick break from the podcast to introduce Chief Outsiders. Chief Outsiders help private equity firms and their portfolio companies accelerate revenue and increase enterprise value fast. Their bench of seasoned growth executives aren't career consultants. They're strategic operators who've led sales and marketing inside real businesses. They embed directly into portfolio companies to drive growth from insight to strategy to execution. And when deeper capability is needed, their on-demand execution teams jump in to get companies to go to market without the delay or long-term cost of full-time hires. Everything they do is backed by a proven, market-tested methodology and an AI-native operating system built from more than 2,000 engagements, bringing collective experience to every initiative. Chief Outsiders have partnered with hundreds of private equity firms and even more than 500 portfolio companies to drive billions in revenue growth. If you're looking to accelerate value creation across your portfolio, visit chiefoutsiders.com. The Chief Outsiders growth starts here. So talk to us about your journey of growing your business, not coming from the atypical, if there is an atypical private equity, I suppose there still is, investment banking type route, but talk to us about building the firm from scratch. Talk to us about that kind of having no institutional backing, not a fund structure. Give us a bit of insight to your journey so far.
So I'd love to sound like a superhero. I'd love to sound like a pioneer. And we thought about this from the beginning, and, we found this gap, and, we're geniuses, but that's just not true. Like you adapt. That's life. You adapt. And so the actual thought of Isaac Management, actually, it came to me, like actually starting the company and all that stuff. I was about 26, actually, so just a couple of years ago. And what really spurred it on was after I went into the private credit business, and I was supporting private equity sponsors doing acquisitions. And the thought that I had was, I mean, people are doing this at a big level. Well, what about the smaller companies? I mean, if you look today, 99% of companies out there today in the private markets, 99% have less than 500 employees. And you can say, okay, well, maybe that they can still be a huge revenue generating company. And that's true. But the vast majority in this kind of lower middle market corridor are within this kind of the revenue range that I talk about, which is like 1 to 5 million, a little bit over, sometimes 10, 20, depending on the deal, et cetera. And so I thought there's got to be like a way to participate on the smaller side, and just did some more research, did some more reading, and it turned out that there was. And so when I originally thought of starting Isaac, I wanted it to be a hedge fund. And growing up, I'd watched guys like Ackman and Icon, and you kind of get this this starry look in your eye, like that's who I want to be. And so I thought about starting a hedge fund. And so I put pen to paper, and I started taking meetings and talking to people and advisors and stuff to really get an idea if it was something that was possible. And they said, well, it's definitely possible, but at the time, this was really kind of peak COVID. And investment capital had really dried up. Everybody was going to cash or running to the hills. Nobody was really able to fundraise. And the worst part was I had to come in without a track record. Because all of the work that I had done when I was at like JP Morgan, for example, I spent some years there. All the work that I had done there, none of that was my own. All of it belonged to the bank.
Yeah.
And so I couldn't market in any way. And so I had to take meetings and they would ask me, what's your track record like? What are your returns like? And I said, well, I can't really talk about that. And I think those are words every investor wants to hear. So I had a really hard time kind of actually getting things together. And that was more public market focused. After that is when I started doing research on kind of the lower middle market. And what popped up on my radar was this thing called a search fund, which I had never heard before at the time. I started reading a little bit more into that. And I said, okay, well, this sounds kind of like micro private equity. And then I learned about short capital. And I had a few exchanges with Justin Ishbia, who is a gentleman. And I don't know him very well, but kind of in passing. And I started the idea really started to take shape. And then I started seeing, again, more changes in the markets, and the hedge fund guys and the active, investors trying to move to more of a permanent capital type of model where investors couldn't just withdraw their money whenever they wanted, which would, you effectively have no control over your returns at that point. I mean, somebody can just pull the rug right out from under you. You have to reposition your entire thesis. And I said, okay, I don't want that. So what do I do? And then it's going to sound super corny, but the Berkshire Hathaway model, which is permanent capital. You have a company that has a balance sheet, you invest the assets that are on its balance sheet. And I said, okay, how do I do that? And, Isaac Management was born. No fund, no life cycles, no investors, no committees, no outside influence. And I think what made it so attractive was we're really at a time right now where some of the bigger players are starting to focus in on the lower middle market because multiples are extremely attractive compared to larger deals. And the margins are really good too, but they're still funds. So they have to sell. And so when you're talking to somebody who's built their company over the last 30, 40 years, somebody who is maybe a second generation, and you tell them, I'm here from private equity and I'm on your side, they kind of wince a little bit because they know you're coming in to buy the company. You have to flip it. And so you're going to juice returns as best as you can. And all that means to them is, how are they going to manipulate our financial statements to extract the most profit possible? And these are conversations that I've had when I'd walk into a meeting and say, oh, I'm a private equity investor. And immediately the tone of the conversation would change and they would become extremely defensive. And it was, they were polite, but I mean, the meeting was effectively over immediately. And so I changed my approach, and I changed it to, instead of a private equity investor, we're a principal investment firm, which is we invest all of our own money, and long-term permanence is really what we're after. Growing these businesses for decades, doing add-ons, roll-on acquisitions. I've even flirted with the idea of taking a company public, not on the NASDAQ, but, but in its kind of relevant platform. But yeah, I mean, that's sort of the call it the metamorphosis of taking a bunch of hits in the face. You just got to reposition and change. And so that's what I did. So what started off as an idea for an activist hedge fund for nano cap stocks turned into a principal investment firm in the lower middle market. And honestly, I couldn't be happier. I think this is my niche. I've done a lot of work in this space. I've been in the industry for a long time. I know a lot of really, really great people. And this is a market that's historically very, very underserved. And when you actually think about the number, small businesses in the United States account for something like 44% of US GDP.
Wow.
Yeah. And you've got something like 35 million small businesses, 28 or so. These numbers are roughly accurate. 28 million are single employee, owner operated. And so this is a huge sliver of the American economy, and it's largely been overlooked. And so, I mean, it's really something to be able to find a place and get into that gap, which we have. And people have been really, really receptive. It's been great.
With the lessons you've had so far, the deals, the seller communications, What have been the big learning points for you from the journey so far?
Biggest lesson I'd say is just authenticity in the way you communicate. Because I'm reading stories now where like an HVAC small business owner will get like 5 calls a week from search funders trying to buy his company. And everybody comes in with the same playbook, which is you've done great, hand it over to us, we'll cash you out. And then basically don't worry about what happens next. And I think from what I've seen, and I could be wrong about this, but this is just what I've seen. The people who have built these companies are very, very concerned with what happens next. Like, this is their legacy. This is what they've built. And you can quote me on this. I never want a person that we transact with to call me a year later and say, what the fuck did you do to my company? So I think being as transparent as possible with what you want to do is the most important. Another lesson is an actual deal structuring. You find that when you bring things up, people are hesitant at first because they're just not aware of this sort of structure. Most of the time, people are looking for a cash for stock swap, which is normal. But there are ways that these business owners can participate in the upside through like an equity rollover or some sort of an earnout with a contingency. Seller financing over time that still sees them earning some sort of an income for the next couple of years as they transition to retirement or whatever. Knowing your stuff before you go into a meeting. Yeah, knowing your stuff before you go into a meeting is really important because you're going to get asked questions by the banker on the call and the owner on the call. And so if you're suggesting, like a 20% equity injection, 60% financing, 20% equity rollover, they're going to say, what the hell's an equity rollover? And that's where you get to explain to them, like, this is how you participate in the upside. And we're going to do, more acquisitions using this platform and not, spin it off into some sort of a holding company or a holdco type of legal structure, and actually like give them the opportunity to perform, So just come in, be prepared, know what you're talking about, be respectful. These folks they're not Wall Street savvy. They're not deal savvy. They're not, they don't do a lot of transactions. This will be the one transaction that they do their whole life. And so just come in with a little bit of sincerity and understanding. I mean, you're going to be fine. Folks who have already contacted either an investment bank or a business broker, like they want to sell, but they don't necessarily know how to sell. They don't know exactly what they want or what they can get. And so it's up to you to bridge the gap, so just be a steward. That's it.
With regards to the low middle market, what's the growth lever that you like to pull that you believe moves the needle in the low middle market businesses, whether it be pricing, M&A, ops, talent, etc.?
Yeah, I think it's in the lower middle market, you can pull all of those levers. I think M&A is a little overdone. You do an acquisition and then you do some sort of a roll up to it, 2 or 3, etc. Yeah, that's going to grow your bottom line and your top line. Congratulations. But anybody can do that. I think where the bodies are actually buried, and it's not in pricing, because pricing it's easy to increase pricing. That's a card trick. Operations is where all the bodies are buried. Operations is where companies go to live and die. And you either have a great back office that knows what they're doing, that are consistent, that are doing things efficiently, or you don't. And a lot of companies in the lower middle market don't necessarily have the budgets to really put together a strong back office. And so there's a huge gap there. And like Carl Icahn said it 1,000 times, and I'm paraphrasing. He said, there's not a single company in America today that I can't walk into and slash 30% in just waste. And I think that that's true. It's more true for the larger companies because you've got big bureaucratic organizations, tens of thousands of people. That goes without saying. Mm-hmm. But in the lower middle market, when you're dealing with a couple of dozen employees, it doesn't make sense to do layoffs. It doesn't make sense to fire people because that one person, that's a key employee and a subject matter expert in that one thing. And so development becomes extremely important. Systems and procedures become extremely important. Optimizing the technology that you're using is important. So operations, bar none, is the most powerful lever that you can pull. Excuse me. And then second to that is talent. Because for every person, I read a study about this not too long ago. For like for an average employee earning like $50,000 a year, to fire and replace that employee costs the company $85,000 a year.
Yep.
Okay, that's a staggering number. So not only do you lose the employee and their productivity, but you think you saved 50 grand when in reality you cost yourself an additional 30 grand. So this backwards level thinking to really juice short-term profits is one of the biggest reasons we stayed out of the fund space and why we stuck to permanent capital. Because if you have a long-term horizon and you have a long-term view of what you want to do, it doesn't make sense to give people an option to pull money out whenever they want, especially in these markets where they're not marked to market every day. Like you can't call up a broker and say, hey, what's my price today? Baby, it don't work that way. So I'd say those two are the most important: back office, operations, talent development, making people feel like they have skin in the game, and that could be, I mean, one of the exit strategies that I teased was ESOP, and giving employees actual shares in the business. And that keeps people really, really engaged. Once they feel like they actually can make an impact, they will. And that's a little psychology, but
Absolutely.
Yeah.
What do you read, watch, listen to that you recommend that others should check out, please?
Watch Staples, CNBC, Bloomberg. Pretty straightforward. What I read is a little bit different. So I'm not like a one journal type of person. What I like to do is I read like a bunch of articles from a bunch of different publications. So like I'll have Bloomberg pulled up and I'll search for something that like a subject that I want to research. And then I'll just read everything that comes in through the pipeline. So that could be Barron's, that could be Financial Times, could even be Benzinga, which is like right here in Detroit. They have some pretty good pieces. Crane's magazine is a really strong publication, especially here in the Midwest. Chicago and Detroit or they have really great business articles. And then kind of your more typical Market Watch, Wall Street Journal, really simple stuff. I don't have like call it a special what do you call it, like a stack of newspapers that I only read those newspapers. But yeah, I stay out of Variety and the gossip columns. I'll say that.
If anybody wishes to reach out to you post this podcast, how best to get in touch, please?
Sure. The best place to reach out is either LinkedIn or through our website, isaacmanagementllc.com. There's a contact form. All of our information is on there. Our email is on there. Our investment criteria, a little background on the firm, myself, what we look for. LinkedIn is really great. We have a page. You can reach out to me personally on LinkedIn as well. I'd say those are probably the two best.
Okay. Marvelous. Well, thank you very much for coming on the Private Equity Podcast and sharing your insights into the lower middle market.
Yeah, man. It's really been a pleasure. Thanks for having me on.
And thank you very much for everybody for yet again tuning in to the Private Equity Podcast. Till the next time, keep smashing it.